You know, when we usually talk about corporate finance, there's like this natural tendency to look at the grand architecture of a company.
Oh, absolutely. The massive 10-year bonds, the huge mergers.
Right, the blockbuster initial public offerings.
Yeah.
It's very easy to think of finance as, I don't know, the massive engine of a sports car.
The heavy metal block that gives the vehicle its power.
Exactly, the
Yeah.
permanent structure. But if you're gearing up to step into a CFO role, or, specifically you, the MBA student listening right now, currently mastering these fundamentals for your exams, we really need to shift that perspective completely.
Because today we aren't talking about the engine block, we're talking about the oil.
Yeah, the vital fluid that keeps those massive metal cylinders from just, grinding to a halt.
Without the engine, you weren't going anywhere. But without the oil.
The engine destroys itself from the inside out in a matter of miles.
Right. And, the long-term debt builds the factory, it buys the heavy machinery. But the short-term finance, that pays the electric bill to keep the lights on inside that factory.
It's the capital that buys the raw materials on a Tuesday, so your workers actually have something to assemble on a Wednesday.
Exactly. And understanding the mechanics of that operational fluid is absolutely critical for your exams.
So we're diving deep into the world of short-term sources of financing today. And the goal here isn't just to read off a list of financial instruments from chapter 3 of the textbook.
No, definitely not. It's to understand the underlying machinery of how money moves on a daily basis.
Right, so that when you're sitting in that exam hall or eventually analyzing a real balance sheet, the underlying logic is just second nature to you.
You'll be able to answer any essay question they throw at you because you actually get the why behind it.
Okay, so to understand the instruments, we have to establish the foundational rules first, like what exactly constitutes short-term financing.
Well, we're looking at a very strict chronological boundary here. It involves borrowing and lending funds for a period of usually 1 year or less.
So 365 days is the absolute ceiling.
Right, and its purpose is highly specific. It's secured to finance current assets.
Things like inventory, raw materials, daily operational costs.
Exactly. And, you'll almost always hear this referred to by its alter ego, which is working capital.
Working capital, that's one of those terms that just gets thrown around boardrooms constantly.
It really does. But it has a very precise mechanical definition that you need to memorize. It is the excess of current assets over current liabilities.
Okay, and current liabilities being those financial obligations that a company has to pay off within the next year.
Yes. So if you look at a company's balance sheet, the current liabilities indicate exactly how much short-term credit is being utilized by the business right now.
Ultimately, short-term financing is the lever a company pulls to maintain its liquidity, right? To meet day-to-day requirements.
Exactly. But beyond just paying the daily bills, a company needs this capital for a few specific strategic reasons.
Like physically holding inventory. I mean, you can't sell what you don't have sitting in a warehouse.
Right. Or facilitating sudden increases in production volume. If a massive order comes in out of nowhere, you need the cash to instantly buy more raw materials.
And crucially, they need it to allow the business to sell goods on credit.
Which is a huge point.
Yeah.
All of those functions basically orbit around one massive concept. It's the reason short-term finance exists at all.
The operating cycle.
Yes, the operating cycle.
Oh, yeah.
It is the crucial time gap between the commencement of production and the realization of sales.
The time gap. It sounds so, innocuous, but that gap is the silent killer of profitable businesses.
Oh, absolutely. It's deadly.
Let's trace a single dollar through this cycle to see how it works mechanically for the students listening. Imagine you run a wholesale bakery.
Okay, I love a bakery analogy.
Right. So day one, you need to buy flour, sugar, and yeast. That is cash physically leaving your bank account.
Right, cash out.
You take those raw materials, and over the next week, your team bakes your famous cakes. That's your production phase.
And at this point, you haven't made a single cent. In fact, you're deeply in the red. Your cash is completely tied up. It's transformed from liquid money in a bank account into the physical form of a cake sitting in a freezer.
Precisely. Now, on day 10, you sell that cake to a local cafe. You've made a sale. Your revenue looks fantastic on your income statement.
But here's the catch, and this really addresses that crucial point about selling on credit. The cafe doesn't hand you a stack of cash upon delivery.
Right. They buy the cake on a 30-day invoice.
So you have technically made a profit, you recorded the revenue, but you don't actually have the money. You have an account receivable.
This is where the operating cycle bites you. because production cannot stop just because you're waiting for a check.
No, tomorrow is day 11. You have a bakery full of staff who expect their weekly wages, and you have to bake more cakes.
Which means you need to buy more flour. But the cafe isn't paying you for another 30 days.
So you have this massive 30-day financial void. You have a profitable, growing business on paper, but your actual bank account is completely empty.
So you use short-term finance. It's the money you use to buy tomorrow's flour and pay tomorrow's wages while you wait for last week's cake to be paid for.
Exactly. It bridges that specific operational gap.
And I guess the longer your operating cycle.
Meaning the longer it takes you to source materials, manufacture the product, sell it, and ultimately collect the cash.
The more short-term financing you're going to need just to survive that gap.
Right. I mean, a company that builds custom airplanes might have an operating cycle of 2 years.
Wow, 2 years.
Yeah. But a company that sells digital software might have an operating cycle of 2 minutes. Their financing needs are fundamentally different.
Okay, let me push back on the core definition of working capital for a second, just to make sure our MBA students have this locked in.
Go for it.
We established that working capital is current assets minus current liabilities. So let's say my bakery has $100,000 in current assets. But let's look at what those assets actually are. Say $80,000 worth of cake sitting in the freezer and $20,000 in unpaid invoices waiting on cafes.
Right, tied up cash.
Meanwhile, I only have $50,000 in current liabilities, mostly wages and a utility bill. Mathematically, my working capital is a positive $50,000.
Yes, on paper.
I have twice as many assets as liabilities. So why would a company in that position ever struggle with liquidity? Like, why do companies with massively positive working capital go bankrupt?
Well, that is the difference between accounting reality and cash flow reality.
Ah, okay.
An accountant looks at your bakery and says you are perfectly healthy. A CFO looks at your bakery and sees an impending disaster.
Because my current asset is a frozen cake.
Exactly. You cannot pay your electricity bill by mailing the utility company a cake.
Right.
You cannot pay your baker's weekly wages by handing them an unpaid invoice from a local cafe.
That makes sense.
An asset tied up in unsold inventory or an uncollected receivable is illiquid. It has value, but it lacks utility in the present moment.
So management of short-term cash flow is completely distinct from looking at a static balance sheet.
It is an exercise in timing. It's about matching the exact day cash comes into the business with the exact day cash must go out.
And if those days don't align, positive working capital won't save you from insolvency.
Not at all.
So if managing this timing gap is a matter of life and death for a business, a logical exam question arises. Why play this dangerous game of constantly gauging the gap at all?
What do you mean?
Like, why rely on short-term fixes? If I'm building a company, why not just go to a commercial bank, take out a massive 10-year loan for $1 million, park it in a checking account, and use that permanent cash pile to cover every single daily operation for the next decade?
Just sit on a mountain of cash.
Yeah, you'd never have to worry about tomorrow's flour again.
It's a tempting thought, honestly. It feels very safe, but financially, it's incredibly inefficient.
Why is that?
A purely long-term strategy creates massive drag on a company's profitability. There are distinct mathematical advantages to using short-term financing over long-term financing.
Okay, the textbook outlines 7 distinct advantages. How do we help the students memorize these?
To keep these straight for an exam, it really helps to categorize the 7 benefits into 3 strategic buckets: cost and tax, access and control.
Cost and tax, access control.
Okay. If we look at corporate decision-making through these 3 lenses, the necessity of short-term debt becomes super obvious.
Let's build a scenario to walk through those buckets. Imagine a company called Apex. They manufacture heavy-duty snowblowers.
Good seasonal example.
Let's look at Apex through the first bucket, cost and tax. Why is short-term credit fundamentally lower in cost for them?
It comes down to how lenders price risk and priority. If a bank lends Apex money for just 30 days, they're taking on very little risk.
Right, because a company's financial soundness or its management team isn't likely to drastically deteriorate in a single month.
Exactly. Furthermore, in the event that Apex does go bankrupt and gets liquidated, short-term creditors generally have priority claims on the income and assets over long-term creditors or equity holders.
Ah, so because the lender has priority in a bankruptcy and the short time horizon eliminates a lot of macroeconomic variables, they accept a lower interest rate.
Lower risk equals lower cost.
That covers the cost part.
Yeah.
What about the tax side of that bucket?
The cost of these funds, specifically the interest payments Apex makes on short-term debt, is tax deductible as a business expense.
That's a massive lever in corporate finance.
It really is. Compare this to equity financing, where a company pays dividends to its shareholders. Dividends are paid out of post-tax profits. They are not tax deductible.
So, by strategically using short-term debt to finance operations, Apex reduces their taxable income,
leading to substantial tax savings at the end of the fiscal year. But wait, if interest payments are tax deductible, why wouldn't Apex just use short-term debt for absolutely everything? Just constantly borrow, pay the interest, artificially lower their tax burden to zero, and never use their own equity.
because that strategy introduces a catastrophic vulnerability known as rollover risk.
Rollover risk?
Yeah, short-term debt has a ticking clock. It's due in less than a year. If Apex relies entirely on 90-day loans, they constantly have to pay back the principal and then immediately borrow it again just to keep the lights on.
They're constantly rolling over the debt.
Right.
And what happens if the music stops?
Exactly. What happens if, on the exact day Apex needs to roll over a $10 million loan, the macroeconomic environment has shifted?
Like a global financial crisis causes credit markets to freeze.
And banks are simply refusing to lend to anyone. Apex might have warehouses full of perfectly good snowblowers, but if they can't secure a new loan that morning, they default on their obligations by the afternoon.
They are instantly insolvent. So while the lower cost and tax savings are real advantages, over-leveraging short-term debt exposes a company to the whims of the global credit markets.
Makes total sense. So that's the cost and tax bucket. Let's look at the second bucket, access. We have three specific textbook benefits here. Short-term funds are easier to obtain, they offer broader availability, and they provide unmatched convenience.
The easier-to-obtain factor ties directly back to the risk profile we just discussed. Because the risk horizon is so condensed, lenders are far more willing to approve short-term credit, even to companies whose credit standing isn't flawless.
Which flows right into the concept of availability. For many small or mid-sized enterprises, short-term credit isn't just an option, it's literally the only source of external financing available to them.
Yeah, a local manufacturer might lack the extensive collateral required to secure a 10-year commercial mortgage. A bank won't underwrite a long-term loan without a massive margin of protection.
But that same manufacturer can easily secure a 30-day line of credit from their raw material supplier.
Exactly. The long-term doors are bolted shut, so the availability of short-term credit is the only thing allowing them to participate in the economy.
And the convenience factor is just like pragmatic matching. If you have weekly payroll obligations or monthly utility bills, securing small, short-term lines of credit perfectly matches the timing and rhythm of those outflows.
It's financially elegant to manage rhythmic short-term expenses with rhythmic short-term financing. The golden rule is to match the life of the asset with the life of the liability.
You don't use a 30-year mortgage to buy a laptop.
No, and you don't use a 30-day loan to build a skyscraper.
Perfect. That brings us to our third and final bucket, control. This encompasses flexibility and the preservation of ownership. Let's bring Apex snowblowers back in to illustrate flexibility.
Apex is the perfect example because they are a highly seasonal business. For 8 months out of the year, their factory is relatively quiet. But in late summer, they have to ramp up massive production, hire temporary workers, buy tons of steel, and build huge inventories to ship out before winter. They only have a massive cash need for about 4 months.
If they had taken my earlier advice and secured a 10-year loan, they'd have millions of dollars sitting idle in a bank account from March through July.
And they'd be paying interest on that idle money every single day.
Which destroys profit margins.
Exactly. Short-term financing provides the flexibility to secure funds exactly when the seasonal spike hits, and the ability to repay those funds the moment the inventory is sold and the cash is collected.
It completely avoids the rigid, inflexible interest drag of long-term debt.
And the final piece of the control bucket, no dilution of ownership.
Right, because if a company needs capital to grow and they don't want to take on debt, their only other option is to issue equity.
They have to sell shares of the company. But every time you sell a share, you dilute the original owner's percentage of the business.
You give up a slice of future profits.
And more importantly, you often give up voting rights and board seats to outside investors.
Whereas short-term creditors don't get a say in corporate governance.
Right. A bank providing a 90-day working capital loan doesn't get to vote on who the next CEO will be. The founders maintain complete strategic control of their enterprise.
Okay, so we have the strategic framework, We understand why a CFO actively chooses short-term debt to manage the operating cycle, utilizing the benefits of cost, access, and control. But where do they actually go to get it?
Well, the instinct is always to say the bank.
Right, but the most common source of short-term finance doesn't involve a bank at all. It happens almost invisibly, thousands of times a day, just through the natural friction of doing business.
We're talking about spontaneous financing.
Specifically, trade credit.
Trade credit is the invisible engine of the global economy. It's defined as credit received from suppliers in the normal course of business.
So when a company orders raw materials, the goods are delivered immediately, but the payment is delayed, usually for a period of 30 to 90 days.
The supplier is effectively giving you an unsecured loan, and as long as you pay within the agreed-upon window, it's a completely cost-free source of financing.
Cost-free capital is the holy grail. I mean, it's staggering to realize that in emerging markets like India, trade credit contributes to roughly 1/3 of all short-term financing.
That's a massive chunk of industrial production running purely on the promise of, I'll pay you next month.
But the length of that credit, whether a supplier gives you 15 days or 120 days, is not arbitrary.
No, it's a complex negotiation of power, liquidity, and market dynamics. There are 4 distinct factors that dictate exactly how much leeway a supplier will give a buyer.
Let's dissect those 4 factors for the exam. The first is the economic nature of the product itself.
The underlying rule here is that products with a high sales turnover and low profit margins are sold on very short credit terms.
Okay, give me an example.
Consider a dairy supplier selling milk to a regional grocery chain. Milk has a razor-thin profit margin and it spoils quickly. The dairy supplier needs to get paid almost immediately to keep their own low-margin operation afloat. They physically can't afford to give the grocery store 90 days to pay for milk that was sold and consumed 85 days ago.
So the economic reality of the product strictly dictates a short credit period.
Exactly.
Now contrast that with a company manufacturing heavy industrial earth movers. Those machines might take 6 months to sell, but they carry a massive profit margin.
Right, and because of that margin cushion, the manufacturer can afford to extend 90 or 120 days of credit to the construction company buying them.
So the physical and economic nature of the product sets the baseline for the negotiation.
Yep. The second factor is the financial circumstance of the seller.
This is a matter of internal liquidity, right?
Exactly. If the supplier is struggling to pay their own operational bills, they have no choice but to demand an early cash settlement from their buyers.
You can't act as a bank for your clients if your own bank account is empty.
Right. However, if a seller is cash rich, they can weaponize their liquidity. They might offer extended 90-day credit terms as a sales promotion.
Peeking ahead on their own cash flow cycle, specifically to win a massive contract away from a competitor who can only afford to offer 30 days.
Exactly. It's a competitive advantage.
The third factor flips the perspective: the financial position of the buyer.
If the buyer has a weak liquidity position, they're naturally going to drag their feet and try to extract the longest credit terms possible just to survive.
Now, a rational supplier would typically avoid trading with such a risky customer, wouldn't they?
You'd think so, but market dynamics often override risk models. If market competition is fierce and the supplier is desperate to maintain their sales volume, they'll accept the heightened risk of slow payment and grant the longer terms.
So the supplier assumes the buyer's credit risk to protect their own market share.
It's a high-stakes game of chicken. Who needs who more?
If I'm the only manufacturer of a patented microchip, I can demand payment in 10 days and buyers will comply.
But if there are 50 manufacturers selling identical plastic cups, the buyer dictates the terms and demands 90 days.
The balance of power determines the credit length. And the final, fourth factor is the mathematical lever of cash discounts.
You'll often see trade credit terms written as 210 net 30.
210 net 30.
This means the buyer has 30 days to pay the full invoice amount. However, if they pay within the first 10 days, the supplier grants a 2% discount on the total bill.
Okay, 2% doesn't sound like much. Why is that a major factor?
Because you have to annualize the cost of missing that discount. If you don't pay on day 10, you are essentially borrowing that money from the supplier for the remaining 20 days.
Right.
Giving up a 2% return for a 20-day loan translates to an annualized interest rate of over 36%.
Wow, over 36%.
It is wildly expensive capital. Therefore, the higher the cash discount offered, the shorter the trade credit period the buyer will actually take.
Because the mathematical incentive to pay early is simply too lucrative to ignore. Think of trade credit like a corporate bar tab. You walk into a venue, you order supplies to keep your operations running. The supplier slides the goods across the counter immediately, but you don't settle the tab until the end of the month.
You're using the supplier's inventory to generate your own revenue today, with the hope that the cash you generate will be enough to settle the tab when it comes due.
If you can manufacture your product, sell it, and collect the cash from your end consumer before your 90-day supplier invoice is due, you've achieved a negative operating cycle.
Which is incredible. You're using your supplier's capital to fund your own growth without ever tapping into your own equity or paying a cent of interest to a bank.
That is masterful financial management.
Truly.
Okay, so trade credit is the perfect engine for acquiring physical inventory. But what happens when a company doesn't need flour or steel?
What do you mean?
Like, what happens when a massive corporation needs raw, unallocated cash? Say, to pay a sudden tax liability, or to fund a massive payroll expansion during a dry month, or to aggressively acquire a smaller competitor.
Well, you can't pay your software engineers or acquire a startup using flour.
Exactly. That forces the company to bypass the physical supply chain entirely and enter a much more exclusive arena. We are stepping into the realm of the corporate heavyweights.
Commercial paper and intercorporate deposits.
Yes, these are instruments designed specifically for elite players. Let's examine commercial paper, or CP.
CP is an unsecured short-term debt instrument issued directly by a creditworthy corporation to investors. The maturity usually ranges from 3 to 6 months.
And it's issued in very large denominations, right?
Yes, often a minimum of 500,000 rupees or more, depending on the regulatory environment. It was introduced in markets like India around 1990 to allow highly rated corporate borrowers to diversify their funding sources away from traditional commercial banks.
The defining characteristic of commercial paper is that it's unsecured. For the students, what does that practically mean?
Unsecured means there is absolutely no collateral backing the debt. If the issuing corporation goes bankrupt, the investors holding the commercial paper have no specific factories, inventory, or assets they can seize to recover their money.
They simply stand in line with the other general creditors during bankruptcy proceedings.
Because the investor's taking on pure corporate risk, this market is entirely closed to average companies. You must have an immaculate balance sheet and a top-tier credit rating to even participate.
If a risky company tried to issue commercial paper, no one would buy it.
Exactly.
Now, the mechanics of how commercial paper is priced is fundamentally different from a standard bank loan. It's issued at a discount. How does an investor actually make a return if there are no monthly interest payments?
It utilizes a zero coupon structure. Instead of borrowing $100 and paying back $100 plus 5% interest in 6 months, the corporation issues a piece of paper with a face value of $100.
Okay.
But today, they sell that piece of paper to an investor for $95.
So the discount replaces the interest rate.
Precisely. The corporation receives $95 in immediate cash. 6 months later, they are obligated to pay the investor the full $100 face value.
That $5 spread is the investor's return, which is calibrated to match prevailing market interest rates.
It's an administratively elegant way to raise massive amounts of capital without the friction of calculating and distributing monthly interest coupons to thousands of investors.
That's brilliant. But because it's unsecured, regulators put strict guardrails around who can issue commercial paper to prevent systemic defaults.
They do. Let's look at the specific eligibility criteria in a market like India based on the text, as it perfectly illustrates the exclusivity of the instrument.
Regulators demand 3 things, right?
First, the tangible net worth of the company must be substantial, for example, not less than rupees 4 crore. This proves the company has significant mass.
Second, the company must have already been sanctioned a working capital limit by a major bank or financial institution.
The regulators are essentially outsourcing the due diligence. I mean, if a major bank trusts the company enough to give them a credit limit, it signals baseline stability.
Right. And the third criterion is that the borrow account must be classified as a standard asset. What does that mean?
A standard asset in banking terminology means the company has a flawless repayment history. They haven't missed a single interest or principal payment.
And if they do miss payments...
If a company misses payments, they're downgraded to a non-performing asset, or NPA. The moment a company becomes an NPA, they are legally barred from the commercial paper market.
The regulators only allow pristine companies to issue unsecured debt.
Precisely.
So commercial paper allows an elite corporation to raise cash from the broader investor market. But what if they want to bypass the public markets entirely?
That brings us to the second heavyweight instrument, the intercorporate deposit, or ICD.
Right. An ICD is an unsecured loan given directly from one corporate entity to another.
Imagine Company A has a massive surplus of cash sitting idle after a profitable quarter, and Company B desperately needs cash for 90 days to fund a short-term project.
The CFO of Company A simply calls the CFO of Company B, they agree on an interest rate, and Company A wires the money directly.
They completely cut out the commercial banks and the public money markets. The most common tenor for an ICD is 90 days, though it can range from a single day up to a year.
But there is a catch. The interest rates in the ICD market are notably higher than standard bank loan rates.
The risk premium is baked in because the lending corporation doesn't have the legal recovery mechanisms or the collateral that a bank would demand.
So put yourself in the shoes of Company B. If you know an ICD carries a higher interest rate than a bank loan, why wouldn't you just go to your bank? Why pay a premium to borrow from another corporation?
You're paying for agility and the preservation of strategic freedom. Securing a corporate bank loan is a bureaucratic nightmare.
Right. The bank will demand updated financial projections, they'll send auditors, they might demand new collateral, and the process could take weeks.
More importantly, banks attach covenants to their loans.
Covenants being strict rules dictating how you can run your own company.
Exactly. A bank covenant might state that you cannot acquire another company or pay dividends to your shareholders or take on any additional debt until the bank loan is paid off.
They've put a straitjacket on the management team.
An ICD, conversely, is lightning fast. The money can be wired the same day the CFOs agree to the terms. There is no new collateral pledged, and there are no restrictive covenants.
So Company B is willing to pay an extra 2% in interest to get the cash immediately and maintain complete operational control of their business.
It's the price of agility.
Okay, so we've covered the spontaneous trust of trade credit for the physical supply chain and the elite unsecured money markets for the corporate heavyweights. But what happens in the messy middle?
The messy middle.
Yeah, what if you aren't a massive conglomerate with a pristine credit rating, but you desperately need cash today? Or what if you're trying to buy vital components from a supplier in Germany who has absolutely no idea who you are and therefore flatly refuses to offer you 90 days of trade credit?
When direct trust does not exist between a buyer and a seller, you have to buy trust. You have to bring in an intermediary.
This brings us to the crucial mechanisms of letters of credit and factoring. Let's start with the letter of credit, or LC.
This is the bedrock of international trade. An LC is a document issued by a financial institution, usually a major bank, guaranteeing that a buyer's payment to a seller will be received on time and for the correct amount.
It's often referred to as an indirect form of working capital financing. Why indirect?
Because the bank isn't actually handing the buyer a suitcase full of cash to go pay the German supplier. Instead, the bank is handing the German supplier an ironclad promise.
The bank is inserting its pristine credit rating in place of the buyer's unknown credit rating.
The credit is still practically being provided by the supplier. They are still putting the goods on a cargo ship before they technically have the cash in hand, but they're only willing to do so because the buyer's bank has guaranteed the payment.
And if the buyer defaults?
The bank legally must step in and pay the supplier. The bank absorbs the risk, bridging the trust gap so the transaction can occur.
That solves the problem of acquiring goods without trust. But what if the problem is that a company has already sold their goods? They have a mountain of unpaid invoices from their customers, and they are suffocating for cash right now to make Friday's payroll.
That introduces one of the most powerful and often misunderstood intermediary tools, factoring.
Factoring.
Factoring is the outright sale of your accounts receivable. You've made $1 million in sales, your customers owe you the money in 90 days, but you need the cash today.
So you approach a specialized financial institution called a factor.
And you sell those invoices to the factor at a discount.
Let's make the mechanics of that discount visceral for the students. I own a logistics company. I have a legally binding invoice proving a reliable client owes me $100,000 next month. I can't wait. I go to a factor. Walk me through the transaction.
Okay, the factor reviews the invoice and agrees to buy it. They will typically advance you between 70 to 85% of the invoice's face value immediately.
Let's say they advance me 80%.
They wire $80,000 into your bank account today. You use that cash to make payroll and keep your trucks on the road.
But I'm missing $20,000.
You haven't lost it yet. The factor now legally owns that invoice. They take over the collection process, they wait the 30 days, and they collect the full $100,000 from your client.
Okay.
Once they have the full amount, they deduct their service fee and interest. Let's say that totals $5,000. They then remit the remaining $15,000 balance back to you.
So ultimately, I received $95,000 for my $100,000 invoice. I paid a $5,000 desperation tax to get my money a month early.
It is an expensive way to finance, but the benefits go beyond just surviving payroll. By releasing up to 85% of tied-up capital instantly, a business can completely reinvent its cash flow.
It provides a source of funding that organically grows precisely as your sales grow. The more invoices you generate, the more cash you can pull forward.
You eliminate the need for an in-house collections department because the factor handles the chasing.
And crucially, having that cash in hand allows you to turn around and pay your own suppliers early, allowing you to take advantage of those lucrative 210 net 30 cash discounts we discussed earlier.
Exactly. But the architecture of a factoring agreement hinges on one critical distinction: recourse factoring versus non-recourse factoring.
This is a classic exam question trap.
It is. This is the pivot point of risk allocation. What happens if the factor buys your $100,000 invoice, but 30 days later, your client has gone bankrupt and completely defaults? Who eats the loss?
Under recourse factoring, the factor has recourse against the seller.
Correct. In recourse factoring, the risk of bad debt remains entirely with you, the business owner. If the client defaults, the factor simply turns around and demands their $80,000 advance back from you.
You assume all the risks associated with the buyer's creditworthiness.
The factor is merely providing an administrative collection service and charging interest on the cash advance. They are not underwriting your client's solvency.
So what happens in non-recourse factoring?
In non-recourse factoring, the factor assumes the entire risk of non-payment. If your client goes bankrupt, the factor takes the $80,000 loss. They cannot legally demand the money back from you.
You effectively bought an insurance policy against your customer defaulting.
Yeah.
But wait, if non-recourse completely shields me from risk, why would any rational business owner ever choose recourse factoring?
Because the insurance policy is incredibly expensive. In a non-recourse agreement, the factor is acting as a credit underwriter. Because they are assuming the risk of a total loss, they charge a significantly higher fee, specifically known as a Delcredere commission.
Okay.
If you're dealing with blue-chip clients who you know will definitely pay, you choose recourse factoring to save money on the fees.
But if you're expanding into a volatile new market with untested clients, you gladly pay the higher Delcredere commission for non-recourse factoring so you can sleep at night, knowing you won't be bankrupted by a client's failure. That perfectly frames it. We have covered a massive amount of ground. We've looked at the supply chain, the corporate money markets, and the intermediaries who buy risk. But at a certain point, a business needs a predictable, structural baseline of short-term cash.
And for that, they inevitably return to the traditional anchor of the financial system. They go to the commercial banks.
Let's dissect the specific mechanisms banks use to deploy short-term capital.
Banks are the ultimate reservoir of working capital financing. They deploy this capital primarily through 4 distinct channels: working capital loans, cash credit, overdrafts, and bill discounting.
The strategic differences between them revolve around flexibility and how interest is calculated. Let's start with the working capital loan.
A working capital loan is a fixed advance, generally repayable within a year. It's usually secured against company assets, but the defining mechanical feature is how the interest is charged.
Right. When a bank approves a $100,000 working capital loan, they credit that lump sum into a separate loan account.
And from that exact moment, the borrower is paying interest on the entire $100,000, regardless of how much they actually utilize.
Even if the company only transfers $10,000 into their operational checking account and leaves $90,000 sitting untouched in the loan account, they are paying daily interest on the full 6-figure sum.
It is a rigid lump sum commitment.
Which feels incredibly inefficient. I mean, why pay for idle capital? This leads us to the second, much more sophisticated channel, cash credit.
Cash credit is the ultimate flexible arrangement. The bank evaluates your inventory and receivables, takes them as collateral, and grants you a sanctioned withdrawal limit, let's say $100,000.
But the fundamental difference is that interest is only paid on the exact amount utilized on any given day.
Exactly. So if you have a $100,000 limit and you only draw down $10,000 to pay a vendor, your daily interest charge is calculated solely on that $10,000.
The remaining $90,000 of available credit cost me nothing in interest.
Right. And the flexibility works in both directions. If a customer pays an invoice 3 days later, You can deposit that cash directly into the cash credit account, immediately reducing your outstanding balance and instantly stopping the interest clock on that amount.
You only pay for the exact amount of capital you use for the exact number of days you use it. So here is the obvious question. If cash credit allows you to optimize your interest expense down to the penny, and a working capital loan charges you interest on a massive lump sum regardless of use, why would any CFO ever take a working capital loan?
Because flexibility carries a hidden price tag. From the bank's perspective, a cash credit facility is a nightmare to manage.
Really?
Yeah. They have to keep $100,000 in liquid reserves available for you to draw upon at a second's notice, but they aren't earning any interest on it until you actually withdraw it.
Oh, right.
To compensate for that liquidity burden, banks generally charge a higher baseline interest rate for a cash credit facility compared to a standard fixed working capital loan.
So if a CFO knows with absolute mathematical certainty that they need exactly $100,000 for exactly 6 months to fund a specific project, the rigid working capital loan will ultimately be cheaper.
But if their daily cash needs fluctuate wildly due to volatile sales cycles, they willingly pay the slightly higher interest rate of cash credit to gain the operational flexibility.
The third channel is the overdraft. On the surface, it sounds identical to cash credit. You have a limit, you only pay interest on what you use. How does an overdraft mechanically differ from a cash credit facility?
There are 3 critical structural differences you need to know. First, a cash credit facility requires the bank to open a brand new, distinct loan account. An overdraft, however, is simply an extension attached to your existing everyday checking or current account.
So when your operational account balance hits zero, the bank simply allows you to keep spending, driving the balance into the negative up to a pre-approved limit.
So it's structurally simpler. The second difference is security. Cash credit requires formal collateral, usually a pledge of your raw materials or finished inventory.
Whereas an overdraft is generally an unsecured facility granted purely on the historical creditworthiness of the borrower and their long-standing relationship with the branch manager.
Exactly. And the third difference is cost. Because an overdraft is typically a smaller limit attached to an active current account, the rate of interest charged on an overdraft is often slightly less than the rate charged under a formal cash credit facility.
So cash credit is a separate, secured, highly structured facility for major operational funding. Overdraft is an unsecured, slightly cheaper safety valve attached to your daily checking account.
That's a perfect summary.
The final bank channel is bill discounting. We touched on this concept earlier with commercial paper and factoring, but how does it operate within a traditional bank?
It's essentially single invoice factoring. Instead of selling your entire ledger of receivables to a factor, you take a specific, legally binding bill of exchange, an ironclad IOU, from a major corporate customer, and you sell that specific piece of paper to the bank at a slight discount.
You get immediate cash to fund your daily operations, and the bank waits until the maturity date to collect the full par value from your customer.
It's a rapid, transactional way to convert a promise of future payment into liquid reality.
There is one final piece of the puzzle that explains how this entire ecosystem actually functions. We've talked endlessly about banks lending money out. But where do the banks get the vast pools of short-term capital required to fund thousands of cash credit accounts and overdrafts?
It comes from time deposits.
Right. A time deposit is a savings account or certificate of deposit held by a retail consumer or another corporation, which requires notice, say, 30 days prior to withdrawal, and imposes steep financial penalties for early withdrawal.
Why does a 30-day notice period matter so much to the bank?
Because it provides mathematical certainty. If a bank relies entirely on everyday checking accounts, millions of customers could theoretically demand all their money back tomorrow, causing a bank run.
The bank wouldn't have the liquidity to fund short-term corporate loans.
But by locking depositors into time deposits with strict notice periods, the bank knows exactly how much capital is securely locked in their vaults for the next 30, 60, or 90 days.
They take that predictable, locked-in retail capital and deploy it into the high-yield corporate channels we just discussed. It completes the circuitry of the financial ecosystem, connecting the retail saver directly to the corporate borrower.
We've mapped the entire territory. We started with the foundational terror of the operating cycle, the silent gap between manufacturing a product and collecting the cash.
We analyzed how CFOs use the cost, access, and control benefits of short-term debt to bridge that gap without destroying their equity.
We navigated the spontaneous negotiations of trade credit, where the balance of power dictates the terms.
We stepped into the elite, unsecured arenas of commercial paper and intercorporate deposits.
We examined how intermediaries like LCs and factoring underwrite trust and risk.
And finally, we decoded the specific mechanics of traditional bank financing, from the rigidity of working capital loans to the fluid dynamics of cash credit and overdrafts.
If you understand the mechanisms behind these instruments, you aren't just prepared for an exam. You are prepared to analyze the financial architecture of any company in the world.
But I want to leave you with one final strategic provocation. Throughout our discussion, short-term finance has been framed primarily as a defensive mechanism.
Right, it's a tool to survive the operating cycle, to bridge the gap, to ensure payroll is met.
But look closely at the underlying mechanics, particularly with tools like factoring or bill discounting. By selling your receivables, you get cash weeks or months early.
Right, and you use that early cash to pay your own suppliers ahead of schedule, which unlocks those massive 2 or 3% cash discounts.
Exactly. If you consistently secure those discounts, your overall cost of goods sold permanently drops.
Wow.
If your production costs are structurally lower than your competitors, you can lower the final retail price of your product without sacrificing a single point of profit margin.
Therefore, short-term financing is not merely a defensive survival tool, it can be weaponized.
Financial velocity as an offensive weapon.
Yes. If you manage your short-term debt and your operating cycle faster and more efficiently than your rival, you can mathematically undercut their prices and steal their market share, all without actually changing a single physical attribute of the product you're selling.
You defeat them not on the factory floor, but purely on the speed of your financial machinery.
You aren't just building a better company, you're building a faster financial engine. That fundamentally changes how you look at a balance sheet. To the future strategic leaders listening, we hope this deep dive has armed you with the understanding you need.
You now have the operational logic and the strategic framework to master the machinery of short-term finance. Good luck on those exams. Thank you for joining us on the journey. We will see you next time on The Deep Dive.